start the. Here, get that. off the screen. Okay. All right. Good afternoon. My name is Vaughn Hedlund. I'm chair of the Committee on Administration. This is a special meeting of the Committee on Administration. Today, we're going to review our audit report from the previous year. Year ended December 31st, 2021. In calling the roll call, I see that we have all members are present via Zoom. I'm here at the in room 60 at the Government Center. We have a number of our staff here also connected via Zoom. Thanks everyone for showing up and attending. Our first item of business here is approval of the minutes. Our last meeting was August 25, 2022. Do I have a motion for that?
So moved.
Okay, Supervisor.
I will second it.
And seconded by Supervisor Zahns. Any corrections or comments about those minutes? Seeing and hearing none. All in favor of approval of minutes from our August 25th meeting, say aye.
Aye.
Aye. Any opposed? Passes. Thank you all. Next, item 5 is consideration of reports, resolutions, and ordinances to the county board coming from this committee. And that is our business today for the year 2021, the county audit that was performed by the firm of Clifton Allen Larson. And we have one of their staff members here today via Zoom. And there's April. Okay, April Anderson. Anyone care to make a motion to tentatively approve the report as you got in your packet? Supervisor Mr. Mike Rogers is here now, and he makes that motion. Second to that?
Second.
We got a second from Supervisor Bauer. All right, we can discuss it, and I'm going to turn this over to April if I can. And April, are you going to start out with a summary?
Yep. Yeah. And so I don't know, do you have copies of it, or you want me to share my screen?
If you could share, because
Okay.
we're via Zoom, so yeah, it'd be easier if you don't mind.
Give me 2 seconds, April. I'll get you
Oh.
the.
Okay.
There you go.
Okay. So I think I'm sharing the right screen. Can you see, it says the executive audit summary?
Okay.
Can you see that?
Yep.
Okay, then. So, yes, we will go over, we issued your final financial statement, your full audit report, which is 80+ pages. And so what we try to do, though, is we pull in what we believe are kind of the key pieces of information here in this executive audit summary to go over with you, more at a high level, but again, what we feel are the key pieces of information. And so this is what we will focus on today. Obviously, it's pulling the numbers and the information straight out of the audit report, but in a more summarized format. So this first page here, the audit findings and results. In the second item, the audit opinion, we issued an unmodified audit opinion. And so that is the highest opinion you can receive. That's considered a clean opinion. And that means that your financial statements are in accordance with generally accepted accounting principles and all of the governmental accounting standards that you have to follow as a governmental entity. And so that's obviously what you're striving to have and your goal there. So positive results there. Then as we go down this page a little bit, the next section is the internal controls. So as we do perform the audit and go through different audit areas and different audit procedures, we are required to report to you then if we notice any internal control deficiencies for the county. And here you'll see that we report 2 material weaknesses. So those are considered more severe internal control weaknesses, and then 1 significant deficiency, which is considered a little less severe of a control deficiency. And so the first one is annual financial reporting under GAAP. And so what this means is that technically management governance is responsible for the financial statements. However, you look to us to provide that assistance to draft the financial statements. So again, as I said, your financial statements are in accordance with all the rules and regulations that you have to follow, but you look to us to help draft the financial statements. And this is one you've seen before. It's a recurring one. And it's very common. We work with over 170 governmental entities in just Northwest Wisconsin, and most of them we report this deficiency because, as I said, it's 80 pages, so it takes a lot of time to pull the information together. There's a lot of unique maybe standards and things like that that you have to follow, and so you look to us to have that expertise to assist with that role and responsibility. The second one that you'll see there is material audit adjustments. And so it kind of fits in with almost the first finding there as well, is that as we do go through the audit, we propose certain adjustments to the balances to get them in accordance with certain regulations and standards. And so again, this is very common because throughout the year, your staff is obviously recording recording activity as they should be, but then at year end, sometimes for the accrual side of things to properly account for things right at 12/31/21, you have to make certain entries to get it into the right accounting period and things like that. And in addition, we help make some of the adjustments for those unique standards relating to Wisconsin retirement system and your OPEB liability and things like that. So, it's a combination of a multitude of things that we assist with there. Then in the next one there, in the significant deficiencies, as I said, it's a little less severe is how we consider it. It's limited segregation of duties. And so what this relates to is that in the different processing of transactions that occur, payroll disbursements, regular disbursements, receiving funds, making journal entries, and all of those different transactional processes, one person shouldn't have access to the different parts of that process. They shouldn't be able to initiate the transaction. They shouldn't be the one reconciling it. They shouldn't be the one reporting on it. In certain instances, that's not possible to maybe necessarily split that out completely with the number of staff that you have involved in the activity. And so that's where we see the limited segregation of duties, where there's some overlapping duties there in the overall scheme of the internal control matrix. I did mention for the first one, but these other two as well are recurring. So they're findings that you've seen in the past, and most likely you'll continue to see into the future as well, just because of the size of the entity, the number of people involved in the process, and then just the assistance that you look to us for. So there aren't any new findings this year. So again, these you are to be aware of these findings, but I wouldn't be completely overly concerned about it being major issues, because there's not new findings and they are ones that you've seen in the past. Then in the next section on this page, we do report just kind of another issue that we don't see as an internal control finding issues, but we feel it is necessary to discuss this with governance and management. And we've had this this section for these other items the last few years. It's kind of been a result of some of the transition into the new accounting system that you had a few years ago, then transition with people, staff transitions as well, people leaving. And so it just left a few holes maybe in some of the processes and at year end, especially when preparing for the audit. And so here you'll see that what we are saying here is that when we do come for the audit, we expect that there will be certain reconciled listings available to tie to certain balances. And we just haven't seen that for necessarily all the balances. Obviously, cash, we get the cash reconciliation, but for certain receivable accounts and payable accounts, that just hasn't been available the last few years. Again, due to timing with staff transitions and transitioning of the accounting system and all of that kind of coming together. So that we did report again this year, but do expect that to eventually be able to be taken out of there as your staff continually try to, get a hold of what their roles and responsibilities are, and as they are able to maybe take on more of this type of stuff on their plate. So before I do move into into the actual numbers for the year and results for the year, are there any questions on these overall results for the audit in what we report? Okay, well then I'll move. Sorry, I have a paper copy, so I got to get to the right page on my paper copy with my notes, and then I'll move us to the right page and on the PDF here that we're seeing. So we'll go to page 8. Okay. Sorry, are you able to see the screen okay? Is it too small or the numbers are okay?
You're good, I think.
Okay. So, okay, then we'll jump into the numbers. And here we start off with your general fund, your main operating fund for the county. And we show a 4-year comparison here just so you can see how things have changed over the last few years, if there's any trends that we want to point out. And so I won't touch on every line here, but just note a few things that you'll see as we look maybe from last year to this year and how the overall results are for the county in the general fund. So here in the cash and investments line, I did want to point out, you'll see that it increased significantly from 2020 to 21, from 4.8 million to about 13 million in cash. And that was a combination of a few different things that I'll mention now, and then it'll be a little bit of a continuing discussion here. But one thing that occurred is, first of all, you received 4.4 million in Arpa funding during the year, and that wasn't necessarily spent yet because you have a couple years to spend that funding. And so the 4.4 million is sitting there in cash. In addition, the Human Services Fund had a positive year, and it's the county's policy to zero that fund out at the end of the year. And so their revenues actually exceeded their expenditures by 1.66 million. And so that was transferred over to the general fund as well. And then NDC had positive results for the year as well of 1.3 million. And they are paying the general fund back for the debt that was incurred long ago, or in 2012, 2013. And they're paying the general fund. The general fund, or the general county, has taken on that debt. So NDC is paying the general fund back as it becomes available. And that transfer was 1.3 million. So in addition, the general fund, you'll see as we get down to the bottom that you were able to add to fund balance quite significantly, just with some of your expenditures being under budget, some of your revenues being over budget, and that sort of thing. So the combination of all those factors really plays into why your cash balance increased for 2021. So then, as I said, when we go down here, you'll see, I'll just note this one, the due from other funds, it's pretty similar to last year. It went up a little bit, but from 2019, that was pretty high in 2019 due to what NDC had as a cash deficit, and the highway had as a cash deficit at that point in time too. And so now with the restructuring that occurred, I don't know if everybody's familiar, has that background, but last year NDC had carried the debt on their books since the inception at 2012, 2013. And then last year in 2020, it was changed where the debt was moved because the NDC couldn't necessarily cover the full debt payment for the year every year. And so the general county took over that responsibility. And now NDC is just paying anything back as it is available to do so. So that's where a lot of the changes you'll see from 2020 to 2021 occur. And I'll just probably kind of refer to the NDC debt restructuring on a high level now. So, but that, so what is still due from other funds really at the end of 2021 relates a lot to a cash deficit in your highway fund, actually. And that's up to about 5 to 6 million at this point in time. So, and I'll get into the highway fund specifically a little bit later. But then as we are looking here at your general fund and really the results for the year, we come down to this fund balance section. And what fund balance is the net of your assets less your liabilities. And so that's really what we consider your reserve, or what has accumulated over time. And so there you'll see that your total fund balance increased by 4.88 million in 2021, increasing your total fund balance to the 17 million. And so again, that increase of about 4.88 million is a combination of factors. It includes that 1.6 million transfer from the Human Services Fund. It includes the 1.3 million transfer from NDC. And then it's a combination of some expenditures being under budget, such as the county manager kind of category in the financial statements. The sheriff department was under budget by quite a bit, and so was health, the public health department. And so, and then on the flip side for revenues, sales tax was about 750,000 higher than expected. And then you had some sales of tax deed properties. So just a combination of all of that stuff really accounted for this $4 million increase. Now, what isn't included in this increase is that the 4.4 million that you received in ARPA funds, since it wasn't applied against any expenditures, it's actually sitting up here as a liability. So you'll see that this liability increased by about 5 million, and 4.4 of that is that ARPA funding sitting there until you actually apply it against expenditures. So in the next couple of years, as you do apply it, you'll see this unearned revenue amount decrease then. So when we do look at that fund balance, as I said, it increased about 4.9 million. It is broken down into different categories right here. And the first category is non-spendables. So this is just, it's stuff that is up on your balance sheet in your assets that's not really in a spendable form. It's not available cash. And so what that relates to mostly is delinquent taxes that aren't really available in the near future. And so that's what the $638,000 is. And then you have assignments. And what assignments relate to is what the county board and management have approved or agreed to set funds aside for. And so what this really relates to is carryovers that are approved at the end of the year. So funds that aren't spent but have been approved to carry over to the next year to be used for that particular purpose. And so you have about $1 million of carryovers at the end of 2021. And that includes $200,000 related to IT specific items. And then there was about $390,000 for public works facilities. And then a lot of your other departments also had certain carryovers that added up to that 1 million. And then the remaining amount that's in there, in that assigned amount of 2.6 million, was 1.6 million was used to balance your 2022 budget. So when you're looking at your budget and you can't get your expenditures to your revenues to equal your expenditures, and you say you'll use fund balance, in your budget for 2022, 1.6 million was used out of fund balance. And so that's what's set aside here in assignments. Because again, you're saying that that funding is basically not available for just anything, because you're going to be using it to balance your budget for the year. So then what does remain though is unassigned. And so that's truly what we consider as being available. And you'll see that that increase, just because of kind of the overall increase that you saw for the year, that increased to 13.9 million. And so what we look at there is kind of a benchmark, is that unassigned fund balance to what your annual expenditures are. And the general recommendation is to have that at about 25 to 33%. And in Northwest Wisconsin, the counties that we work with, the average is a little bit higher than that. It's generally around 35 to 45%. And here you'll see with the increase that you did have in your unassigned fund balance that you're at 60.6%. And so the last few years you've been at that kind of average of 38 to 40%. And now it jumped up there to that 60%. So, and again, that's a combination of the overall fund balance increasing. And then you did actually assign more, you had higher assignments, but yes, your unassigned fund balance just went up that much. And so we discussed a little bit before this meeting as far as, you know, maybe assigning for other particular purposes. If you wanted to put more funds, kind of set them aside for certain purposes like sick vacation leave that might have to get paid out, or the OPEB related benefits, so retirement benefits that have to get paid out. And so that would obviously, if you assign more funds for that, that would bring that assignment number up, and then you'd be pulling that out of an assigned fund balance. So, but as of 2021, what you had assigned was 2.6 million, and that left the 13.9 million unassigned. So, otherwise, I think that those were the overall results that I wanted to talk about for the general fund. Are there any questions on that before we would get into the other funds that you report?
Any questions, anyone?
Okay.
April,
Well, then I'll.
April, I have a quick, I'm sorry, I have a quick question. So that assigned balance this year includes the money committed I'm sorry, the assigned balance at the end of last year includes the money committed for this year from the general fund to balance the budget. If that's not spent, then that just gets adjusted and then is reflected in the assignment balance at the end of 2022. Is that correct?
Correct. Yep. Your assigned fund balance would adjust accordingly. If there were carryovers, so if it doesn't get spent and there were carryovers for the specific departments that it wasn't spent in, you know, then you'd have those as carryovers. So it could potentially stay in assigned fund balance for that purpose, but yes, otherwise it would, you know, if you don't have to use so much of fund balance to balance your budget, if you don't have to use any, hopefully, or if you have to use less in 2023 as you're going through the process right now, yes, then that number would essentially come down to whatever that new balance would be. So, okay, well, if any other questions just come up, just let me know, but I like to kind of pause and let give the opportunity there. So then we'll move into this next section, item number 2, which is your special revenue funds. And you report 4 different special revenue funds. And I had already mentioned human services, that it is the county policy to zero that out at the end of the year. So if human services has a deficit where expenditures exceed revenues, there would be a transfer from the general fund to cover that deficit. However, in 2021, it was a very positive year, as I said, in that Human Services was able to transfer 1.6 million back to the general fund. And actually for the last 3 years, I think the Human Services Fund has been able to transfer back to the general fund. So again, that's not always the case. There were some opposite situations in 2018 and in the last couple, or a couple years prior to that, where the general fund had to cover it. So it's back and forth depending on the results for the year. And when you have certain high cost clients or things like that come about, it can change significantly one way or the other from year to year. So but that was positive for this year. And then the other 3 special revenue funds that you report is the jail assessment fund. And so you'll see that last year that fund balance actually went down because you did some upgrades and you had some additional costs for the year for some upgrades over there at the jail. And so now you've been able to bring some of those fees back in and build up your fund balance a little bit until maybe something else comes up that you have to spend it on again. Then for the solid waste department, you'll see that ending fund balance for the year, even though the activity in there subsided in 2021, the fund balance increased due to some of the sale of the property that you have related to that activity and that operation. So that is why that increased. And then the last special revenue fund that you have is your Cdbg revolving loan fund. And that can obviously kind of go up and down from year to year, depending on the loan repayments that you receive and then the loans that are issued out. And in 2021, loan repayments were $80,000 and only $15,000 of new loans were issued. So that's why that one increased during the year. So then we move into your debt service fund, which is used just for that purpose of either levying in or transferring in funds to pay for your principal and interest payments for your debt for the year. And here you'll see that fund balance is significantly higher the last 2 years. And that's due to a unique debt transaction that the county has going on, and that it was a crossover refunding is what it's called. So debt was issued in 2020 to pay off bonds in 2022 when they're callable. And so next year in 2022, that balance will go back down to more of a pretty low balance. And that's kind of expected, that you wouldn't have too much of a balance in the debt service fund, except for in a unique circumstance like this, because generally you'd only transfer in or levy into the fund what you need for your principal and interest for the year. So again, it's a unique amount right now, but will go down in 2022. And during 2021, you did make 3.55 million of principal interest payments out of this on your general obligation debt, and then 1.4 million of interest payments for the year in 2021. Then the last governmental fund that you report is the Capital Projects Fund. And this is used to record the activity for certain capital projects that occur. And so generally these balances will fluctuate from year to year because of issuing debt and then spending it down. And so last year you had spent down then all the debt that you had issued previously. And then in 2021, you issued about $1.2 million of debt into this fund. And you'll see that about $595,000 is still there that was unspent at the end of 2021. So, you expect that to come down as you incur those expenditures related to what that debt was issued for. So then we'll move into item number 5, which is your highway department. And here, I had mentioned earlier that the last couple years, you have actually not had any available cash necessarily at the end of the year in the highway department. And so you'll see that kind of stems from, if you look at 2019, there was a big deficit, negative 3.3 million. Last year, you had another deficit of 773,000, where expenditures in the highway department exceeded revenues by that much. And so that kind of took out or kind of was what caused the cash deficit back then, and now you haven't been able to necessarily get back into positive cash. But in the current year, you'll see that the change in net position is actually a positive $697,000. So so that was positive results, especially with the last couple of years where the expenditures have been a little bit higher. The revenues haven't been able to cover that. So positive results there to be able to have add 700,000 back to the net position for the year. However, you will see that even with that, your unrestricted net position is still at a deficit balance there. So it is coming down, but if we did talk in a management meeting that I had with Chris and Beata and a few others as far as what you might have to look at there as far as if the highway will need a little boost in funding to be able to kind of get itself back to a level playing field there. And one benchmark that we look at for the highway department is called the current ratio. And so that means your current assets, your available cash, available receivables that will be available shortly after year end compared to your current liabilities. So what you have to pay shortly after year end for 2021 expenditures. And so you want that to be at least a 1-to-1 ratio. And you'll see that in the last few years, you have been under that 1-to-1 ratio. So again, kind of consistent results as far as what occurred in 2019 and now how that's played out the last couple of years. For NDC, I'm going to kind of just focus, we have the balance sheet here, but I will kind of just focus on the overall results for the year down here and what the change in net position was for the year. And so last year, as I said, for 2020, it was a really unique situation where you restructured the debt. And so that's why there was a $23 million positive to the net position in 2020. And then for 2021, though, their operations actually was a positive 1.3 million. And then they transferred the 1.3 million out of what they had for available cash, as I said, to pay the general fund back for, their portion of the debt of what they could pay on the debt. And so that's why you see a zero balance in the cash and investments, is because what was available at the end of the year from the operations, because there was positive results there of 1.3 million, was then paid back to the general county. So that zeroed out the cash. And then ultimately was a negative $60,000 in change in that position. But and then we have the Transit Commission as your last enterprise fund that is reported. And so here you'll see that the last couple of years, the Transit Commission has been doing well. Here they had a positive change in that position of 98, almost $99,000. So again, their revenues exceeded their expenditures for that particular operating item for the year. And then here I also show the current net, or the current ratio, and just similar to highway, a 1-to-1 ratio on what your current assets to your current liabilities are. And so the Transit Commission is well over that 1-to-1 ratio at 5.3 at the end of the year. So then the last two funds that the county reports are called internal service funds. Oops, went a little too far. Sorry about that. And your first one, and so these funds are kind of to record activity that relate to somewhat providing services just internally within the county. And so you have your workers' comp fund, where that is simply providing that particular workers' comp insurance and activity for your county employees and the county overall. And so here you'll see that it was almost a break even year for this fund, and a positive net position add of $1,423. So you've had a couple really good years there as far as high claims years, and you're able to kind of bring that net position back up to a $2.5 million balance. But obviously that's there's ebbs and flows in that activity, because you know, if you have a high claim year, then you have some funds available to help offset that if expenditures exceed your revenues in future years. Similar thing for your health insurance fund is that in 2018 and 19, you'll see that you had some very high cost years, deficits. And so this year was positive results with being able to add to net position $672,000 there. So you had a positive year there where claims didn't exceed the revenues that were going into there. So that is the last fund in the different kind of buckets that all the activity for the county is broken out into. The last thing that we show here is item number 7, where we just like to discuss what your long-term obligations are for the county, and what you have to pay into the future. And so here you'll see that your general obligation debt is at $46.895 million. And similar to what I said when we were talking about the debt service fund, where your principal and interest are paid out of, the last couple of years that balance has been higher because you're kind of carrying two bond issues at the same time until it was paid off in 2022. So in 2022, you know, I'll expect to see that come down unless you issue new debt, but expect that to come down by about 13.9 million is what the debt issue was. So, and what we look at there for your general obligation debt is that every municipality, county, school district in the state has a debt limit. That is, for the county, it's equal to 5% of the overall equalized value within the county. And so you'll see that your debt limit is 191 million. And so your 46 million that you have outstanding in general obligation debt is about 24% of that. And so the county average that we see in Northwest Wisconsin ranges from about 0 to 20%. So you're a little bit higher than that, but if you kind of back out that 13.9 million that's already paid off in 2022, you're at about 17 to 19% the last couple of years. So right within the range that we generally have seen for counties. And so then what else we have here in this long-term obligation section besides the debt is the compensated absences that I somewhat hit on, talking about unassigned and assigned fund balance in the general fund. And so here you'll see that this is what's estimated as far as what your employees have earned at the end of the year for like vacation, sick, PTO type leave. And so in the governmental activities, that's estimated at about 2.9 million. And then in your business type activities, which is the neighbors, highway, and transit commission are those 3, would be the estimate is about 1.5 million. And so again, for the business type activities, this balance actually sits on their balance sheet as a liability to be paid out into the future. But for the governmental activities, this is just an estimated amount. And then as you do pay it out, that's when it's expensed. And so that's why we talked about if you wanted to set aside some funds for that particular expense, because sometimes if you have some major retirements during a year, or uses of that sick and vacation type leave, you know, it can add up to be a significant amount in certain years. So if you wanted to set aside some fund balance for that particular expense, if it occurs. So that is the end of this high level summary that I wanted to go over with you. Are there any questions or?
Anyone have any questions? Now would be the time to
I have one question, if I may, Mr. Chairman.
go ahead. Thank you.
All right, so you said if on this debt that you were talking about, if we back out 13 million, that would bring our percentage down to 17 approximately percent. And I'm assuming that since that transaction will be finished in 22, the numbers will be reflected in the 22 audit. Am I correct in that assumption?
Correct. It will be reflected in, because this is for what was relevant at the end of 12/31/21. So yes, in 2022, though, yes, it would reflect a decrease in the general obligation amount of what's outstanding at the end of 2022. And then, equalized value hopefully is going up. And so hopefully your limit overall would go up as well. And so, yes, then I would expect that if you don't issue any new debt or anything like that, that would increase the debt balance. You'd be down about that 17% range, even maybe lower, depending on how it all plays out.
Okay, thank you for that clarification.
Thank you, Supervisor Lena. Anyone else? No, April, I thank you very much. Very good presentation. And I know it, appreciate you answering the questions that we had brought up prior to the, before we got started here with the meeting. I know,
Okay.
like I say, there are a couple of budget questions that we had and whether we should or shouldn't. And it was nice to see just right now how we're doing it. So thank you much.
Okay.
Anything else for April? If not, April, do you have anything else for us that you want to cover?
Nope. I will see you then on Wednesday evening for the full board, and we'll see you there then.
Well, thank you very much, April.
Okay. Have a good evening.
Yeah, bye now.
Thanks.
Okay, any of the supervisors have any questions or comments they care to make before we make a motion to pass this on to the county board for approval? Okay, basically, we have voted to accept it. Would you care for an extension of that vote, or you satisfied that we're good to go? I think we're good to go. Thank you all for attending. And again, like I say, I think April does such a fine job for us in her explanations. And like I said, I did bring that up. If you saw that in your report, that OPEB liability was about 2.6 million. And again, that's that, when employees retire and they leave that money here and they can use that for extended health coverages and things like that. But it, it's money that's in our system, money that's showing up in a sense in our checkbook, but it is a sign for that. And we could in the future, Chris and I talked about it. If we wanted to, we could have the departments we could take a look at a 5-year average of what we have left each year. And if we wanted to set aside that amount of money in a sense of, an assigned fund to pay for those retirements, we could do that. And then we could just review it each year and see if we're gaining or losing, like we do with the work comp funds or that type of thing. So, if you think you'd like to see something like that, you can let me know or let Chris know, or we can bring it up at our next meeting on Thursday. But I think that something that Mike brought up at our previous meeting, and I think it, it's a good thought. It's good governance. We're not breaking any rules by doing it the way we are, but I think might be a good consideration for future planning. All right. Anyone else have any announcements? If not, our next meeting will be back here Thursday afternoon. Our regular time was 3 o'clock start. Look forward to seeing everybody then. Thank you all for coming. Chris, take care of that yourself and hope you get better. Your voice stays with you. Meeting is adjourned. Thank you all.
You guys have a good evening.
Yeah.